Hello, ladies and gentlemen. I think we're ready to start this session. In our next session, we've gathered a team of experts to get a deeper understanding of the factors that shape the liquidity landscape and how our industry is strategizing. Please welcome our moderator, Hormoz Faryar, who is the head of institutional sales at ADSS and will introduce our speakers to you. Welcome, Hormoz.
Thank you. Hi, everyone, and welcome to the liquidity panel here in Cyprus. And I'm just going to briefly go through and introduce you guys. I might let you do it yourselves for like 10 seconds each or something. I know each of these panelists, actually, and we have an amazing group of experts in the subject of FX and liquidity, so I'm looking forward to this. So, Jonathan, if we can briefly go through what you guys do and what you're good at, your company, not you, your company.
It works. Okay. Yeah. So I'm Francois Nembrini, MFP Trading, agency FX brokerage. So basically, we provide spot FX liquidity to typically bank and hedge funds. We have a structure which is the one of an ECN, so centrally cleared by Royal Bank of Scotland. And basically, we do not touch credit, so we're just an intermediary. We never kind of accept customer cash or do this type of situation. We just arrange trades and provide technology for routing orders in the best way possible, being an aggregated workflow, a full amount workflow, or we have some algos that allow you to work your orders into the market. So focus on the execution and the routing orders and not providing credit. But that's me.
Jonathan?
Is it one? Yeah.
By the way, Royal Bank of Scotland, it's now called...
Yeah, it's not Commerce, it's not Dresdner, it's Commerce Bank, and it's not RBS, it's NatWest. Sorry. NatWest.
Hi, I'm Johnny from IS Prime. I'm one of the two founding partners of the business. We are, I suppose, the traditional term would be a prime of prime, but we see ourselves more as a liquidity provider than a liquidity reseller. So we originate our own liquidity in foreign exchange, bullion, and indices, and we're one of the predominant providers of liquidity to the retail broker space.
Chris?
Hi there, I'm Chris from IXO Prime. We are an institutional liquidity provider. Do things very simply, keep it nice and basic. FX, CFDs, cryptos, provide credit, but yeah, we keep it very simple. Not as exciting as these other two.
Marcus?
Hi, I'm Marcus from 8cap. I'm the Director of Operations. A bit more of the odd one out on this panel coming from the retail space, but 8cap's a global CFD broker, specializing in retail, and I guess we have a bit of a sort of a different twist on liquidity coming from the crypto side. So we provide sort of an industry-leading regulated crypto offering with over 300 crypto CFDs that we've sourced and aggregated liquidity through ourselves. So I think that's sort of my place on this panel.
Great, thank you. So my first question today is about liquidity events year to date. I just wanted to have a recap of what's happened this year in terms of FX, CFD markets. Anything big happened this year? A couple of things comes to mind, but I'll let you guys, maybe Jonathan, if you can start recapping what's been the big things year to date.
Well, I suppose there's some things going on in Ukraine at the minute, so that's obviously led to quite a big, or had quite a big impact on the wholesale liquidity market. So obviously in terms of actually kind of the directionality, it's obviously led to huge asset price inflation, particularly in the commodities. So that's been pretty good for typically sort of trend following type strategies. A lot of retail trading strategies tend to be a bit more of a mean reversion type of strategies. So I think that those have been struggling somewhat. Liquidity in the institutional markets actually dried up a little bit. So we had a period of kind of high volatility, which led to liquidity obviously slightly widening, but then sort of institutional spreads kind of came in a little bit, and then over the last 4 to 6 weeks, wholesale market spreads have gone out. In the retail market, that hasn't really fed through into the retail market particularly just yet. But so the liquidity story at the minute is that there is actually quite, particularly in FX, sort of quite scarce liquidity, and not a lot of liquidity bouncing around the institutional markets at the minute. In terms of other liquidity events year to date, Do you know what? The news flow has been so dominated by Ukraine by the Ukraine war over the last few months that it's almost difficult to kind of remember anything that happened before it. So
I remember one thing that didn't happen. Everyone thought gold is going to go crazy when the war starts and stuff, and it didn't. Right? That was one of the kind of non-events, essentially, isn't it? I guess, Marcus, you guys would see, more of the retail end users on the retail space. Did you see any of that this year? Like, was the gold?
We definitely saw on the retail side people following the news with gold and probably got let down quite a lot on that. So yeah, I can definitely speak to that. But yeah, I think on the retail sort of side, I think we did see it coming to pretty both-sided, I think, following on from that with volatility. But, it definitely became a large part of the client book and the portfolio, following on from that, as did oil and, people trying to get in on the ruble shorts, while they still could before it's cut off. But yeah, I think we definitely saw people trying to really sort of, I guess, place their bets around gold as fast as possible and during that whole event, and they still are.
Yeah.
I guess there was quite a big liquidity event recently in cryptos as well.
Just a tiny bit. I was going to touch on that. So it's kind of interesting, obviously, with this downturn in, crypto related, sort of, I guess in reaction to a lot of what's happening with inflation in the US, and it's become, it meant to be an inflationary hedge, but we definitely haven't seen that happen. But I guess talking on the CFD liquidity side, I think we saw spreads still hold up really well, even in this fast downtrending market. I think, the elephant in the room when it comes to crypto liquidity issues is going to be, Luna pretty much imploding recently. And became an interesting situation, I think, for retail brokers, for liquidity providers, because, until sort of a final decision was made by the protocol, which, is something different. That doesn't really happen a whole lot, in liquidity, that someone's holding all the cards, everyone's acting differently. No one knows what to do.
Yeah, Luna is where it collapsed 99%, right? In a few
Exactly.
days.
I mean,
how many of you priced Luna, by the way? Only one. Okay.
Yeah, so I'm
your
probably.
clients got.
So yeah, I think we definitely saw interesting client reactions to the Luna sort of pricing issues at the time, because you're looking out there and some people are going to delist it, some people are changing conditions, some people are going long only, and you pretty much have to make it up as you go in the moment to provide good conditions to end clients in that. So I think we managed it well on our side, but it definitely wasn't easy. But I think we're going to see more of these events come up in the crypto space in the future, because you're beholden to a protocol. If there's an issue or something, everyone's there with bated breath just waiting to see, well, are they going to shut it down? Are they going to try something new? Are they going to, fork the chain or something like that? I don't know. But it's kind of an interesting situation that I think we're going to have to get used to, because we're going to see more of it.
Yeah. Francois, what did you guys see year to date in terms of, if you remove a lot of clients out of, let's say, Russia and Ukraine, that must have impacted the world.
Yes,
London, even where you're sitting in London, right?
Yes, I mean, especially for MFP Trading, we had a bit of a niche business in ruble, which was 30% of our business, so... it was a kind of an uncomfortable event for us, but obviously you remove all the Russian banks trading from the system, and so you see, obviously, as John said, there's less traders, so there's less liquidity, so institutional spread have actually widened a little bit. There was a study from a guy at Deutsche that saying that pretty much the spread in euro dollar are 0.1 wider than they were before the war, and you did the list of all currencies, which I forgot, but anyway, the point is there's less liquidity. Massive liquidity event by removing all those banks, all those counterparties, and removing an entire currency pretty much from the trading realm of spot FX. And I will go further now, saying we have because of this war an inflation that's going back actually a bit more than people were expecting. Everybody expected inflation to go up and go down fairly quickly. Now we're in a mode where inflation is going up a lot, and we're talking a lot about rates going higher. And I think this is the big event in FX, because me, for the past 5 years, I felt like a dinosaur smelling like cheese, where FX was not moving, there was no rates, and maybe for somebody in the room that are more than 10 years in the business, you remember carry trades, right, where everybody was trading the rate differential with leverage and doing a lot of FX flow, and euro dollar used to move 200 points a day, and sterling yen was moving 300-400 points a day. All these moves have disappeared because there's no excitement in FX anymore. And people have gone to other instruments and to cryptos, and for like an old guy like me that just stayed with the FX, I had nostalgia about those times. And
can you explain? Yeah, exactly. You're back in business soon, I think.
But I hope so.
Can you explain carry trade for everyone? Just I know we have online audience as well. So carry trade, your definition of how
but basically,
people look at it, easy way of making money.
Let's say you can borrow Japanese yen at like very low rates, and you can reinvest it, let's say, in sterling, which at the time when I was starting my career was probably 5 or 6% or something like that. So you were making 6% on a cash position. So you can leverage it 2-3 times, and you were being paid 10-20% a year just to hold a position.
So basically, you just take whatever is the biggest, let's say, swap, daily swap, paying currency pair, and you just buy that.
Exactly. And so that used to generate a massive amount of FX flow. And with the rates going to zero, in a lot of cases even negative, that kind of strategy disappeared and FX kind of became more stable. And so now we have an environment where you have less liquidity, not only because you have maybe the Ukraine war and things like that, but the banks have risk limits which are much lower. Right, like you had like traders taking very big positions, you had didn't have so many MiFID rules and things like that. So the major investment banks were allowed to follow customer orders, they were allowed to front run customer orders, they were allowed to do a lot of strategies that they're not allowed to do these days. And so you have banks that are more conservative in the way they price. You have a concentration of market maker in a few hands, and you have a lot less risk that's available. So the bottom line is, while the spreads are much more attractive than they used to be, probably 5 or 10 years ago, I think we're in a situation where the market is a little more fickle, and you have a potential for very big gaps and very big movement up and very quickly. So I think it's important to come back to the basics of the business, to be able to do voice trades, to be able to have redundancies and have people that are competent. I mean, we had an out trade with Barclays a couple months ago, and I was shocked when I give the Barclays trade reference to the people at Barclays. It took them 15 minutes to confirm the trade or not, right? And there was no problem with Barclays. It was my system that had a bit of a hiccup, right? Wow. So you need to understand all this to see that potentially we're in front of a big tectonic crisis if the market moves quickly and people don't have the experience to be able to go back to, hey, we do phone dealing now, and so for me, it's a very interesting period. I'm very excited about it because, as I said, I was smelling like cheese for the past 5 years, and I'm hoping that FX is back. And I think liquidity is not as deep and not as plentiful as people think. In any case,
okay. But there's almost this dichotomy in the FX market where there's the institutional market and then there's the retail market, which are almost two completely separate but interrelated liquidity pools, right? So obviously retail's always been a significant part of the overall global FX trading activity, but anecdotal evidence would suggest that it's actually become a significantly higher proportion of the overall global retail, the global FX trading activity. So
retail's growing. Generally speaking,
I think probably institutional liquidity and trading is reducing, and I think retail probably is still growing, which is actually, I think, as sort of to touch on what Francois said, I think that's actually potentially quite a risk for the retail market, because there's arguably too much, and there's arguably sort of artificial liquidity that is going around the retail market. We've banged on and bored people about reaggregation, for example, which is one of the examples that creates a liquidity mirage. But ultimately, the retail FX liquidity is still, or the retail FX trading is still underpinned by institutional markets. And so if the institutional markets continue to kind of dry up and reduce in liquidity, then just the intrinsic volatility within the market is going to increase, which is, I suppose, both an opportunity and a threat to the retail market.
Yeah, there's a couple of things I want to pick up on, but first, Chris, year to date, sort of.
Yeah, it's interesting listening to the guys. They've all touched on various different asset classes and products. And one thing as a market maker, you're always worried about concentration risk. And typically, we're always worried, are we become a gold broker? Because you've always got huge gold positions, huge euro-dollar positions. And now it's nice to see that everything is moving. So as a market maker, that's what you strive for. You want volatility. But it's nice to see euro-dollars finally moving after years of doing nothing. And ironically, sort of you referenced earlier, gold is sort of in the middle of that year range. That's quite nice for us because we can take a bit of a back seat on gold, because we're always, I think everyone up here knows, you go to sleep thinking, what's happening tomorrow on gold? Is that going to kill us or make us very, very wealthy? But it's nice that, like I say, we've got cryptos are now coming into. Who'd have thought years ago we'd have said crypto was a nice risk, sort of various somewhere else to look for risk. So yeah, no, it's been an exciting few months.
Just been good in terms of. So I just wanted to touch on what you guys mentioned, the carry trade, right? The carry trade, like we said, is when people take this position to make easy money every night, kind of thing on the position they take. I remember this 10 years ago being called the Japanese housewife's trade, right? Where they were sitting there just taking the yen position to just make money every night, literally. Would the banks, are the banks involved with the carry trade as well, or is it just a retail?
Well, I think the macro funds are involved in that, right? So macro has not been very sexy for the past, for probably this past decade, like you're the big Soros and those guys.
They would also do the carry trade.
They're massively in the carry trade. That's their main trade.
And that'll come back.
I think that might, like listen,
rates.
I'm hoping for rates to go up, so there's going to be some excitement in FX, okay? But so maybe I'm right, maybe I'm wrong, but
Francois clearly doesn't have a mortgage.
Yeah, exactly.
You sold the house, you're ready for the
fixed rates. I borrow as much as I can, and so so I think it's very possible that this come back. You have an inflation like what 9% in the UK, and this is enormous, right? So if they raise rates to 4-5%, and Japan keeps on saying we're not going to raise rates, the carry trade is back. If you're at 0% in Japan and 5% in the UK, you put leverage 4, which in this industry people are going to be like, what is this? It's so peanuts. I leverage my guys 20 or 30 times or 40 times, right? So more. So if you do 4% multiplied by 10, it's 40% a year just holding a position, right? This is definitely a strategy to have. And then for the brokers, it's perfect because he goes up very quickly. It's like the Russian mountains, what do you call that in English? In French, it's montagne russe. That this attraction where you go up in the cart and you go up, and then like, woof, you go down, But that's what it is. So the market goes up, everybody catch the carry, people suddenly goes down, and people are like, oh my God, I need to get out of this. And so like then you have those massive moves, which are interesting to watch, right, and to broke. Yeah. I'm hoping he's back, we'll see, but to me, like Lagarde said, that she went to raise rate in September. Now we're talking about July. In the US, it's like 25% basis point. Now we're talking 50% basis point every time.
You never know. Some of the economists yesterday, they think it's not going to happen. They're thinking that it's all going to be just a 0.5%, 1%, maybe, and then it's going to be too many people screaming and shouting about mortgages that they have, or and then they won't raise the rates much more after that. But we'll see. We'll know.
That's what
next
we were
conference
saying 6 months ago. But me, I'm like the cheerleader of high rates. So but the bottom line is you have big events in FX, right? You have like a war. You have a market participant being cut off the market. You have a rate situation which is interesting. You have high inflation. I think the market is going to be very exciting in an environment where you have a lot of young traders. You have a technology that has replaced people. I mean, a friend of mine at Morgan Stanley was saying that he was ending 400 accounts. I'm not sure how you can handle 400 accounts by yourself, right? He never talks to his client, pretty much.
Yeah,
so you have people that have lost the contact, people that are used to machines, people that are used to a quiet environment that doesn't move, where if you have an off trade, who cares? Euro moved 30% today. So if I call you now in 5 minutes, who cares?
But now we'll go work at the banks again, huh?
Yeah. I'm not so sure of the amount of compliance we have to do these days.
There is no amount of money you could pay me to go back to the banks.
Yeah, you have to pay, you have to fill a slip to go to the bathroom.
Yeah, so... okay, so I just want to move on to the next question, which is the multi-asset class story. So you guys are, pretty much specialized in FX and CFDs. Here comes a few new asset classes where people kind of a little bit, everyone talks about multi-asset. They go, why don't you guys get into crypto? Why don't you guys get into equities trading? Why don't you guys go multi-asset class, fixed income? Does that, some of you are clearly trying to do it or have done it. Does that disrupt a little bit the traditional liquidity management focus? Like if your team is focused on FX for years, and then do you split the team? Do you split your technologies? Is it just a problem, or is it a good thing for the liquidity side to have these new asset classes come in? What do you think, Marcus?
Yeah, look, I guess I come at it from a different angle at the end of the day, but so for us, when we went out looking for crypto liquidity, this is a few years ago now, there wasn't really a whole lot on the table. So with us, obviously we're not a liquidity provider, not a prime of prime, anything like that. So we really had to start it from scratch. And so we're really building the ship as we sailed it. So in a different position there, we didn't have, the same teams that, everyone else up on stage has. So I think that gave us a bit of freedom, made a lot of mistakes, but I think they helped us learn, good mistakes at the end of the day to help build this out and do it from scratch, because, you can't operate in the normal liquidity paradigm. But I think there are players out there that are doing that. We're seeing more traditional clearing houses, clearing venues doing crypto. We're seeing, DeFi doing crypto futures clearing. We're seeing centralized exchange, decentralized exchanges, whole various, different ways that crypto liquidity is being formed and distributed. And, there's no right answers just yet. Like the jury's still out on that. So in that sense, I can't speak for everyone else up here, but the rules are kind of a bit different, I guess. So I think there's a lot of different avenues that people can look down, and we get to see which one will be gospel at the end of the day. Maybe they all work in different ways, and people gravitate to different ones for different reasons. But yeah, from our angle, we pretty much had to deploy resources directly for this because there wasn't a solution out there. And maybe we'll see more retail brokers do that in the future if they're not getting the direct sort of request or things that they can get from their prime providers or liquidity providers. I'm not sure, but that was just the position we were in.
Yeah, Chris, like your liquidity providers, do you expect them to become multi-asset class? Like, would you expect, let's say, these guys to get involved and become, or do you think there's going to be FX guys, you'll have different liquidity providers completely?
I think we've all had to evolve, and now the expectation is it's multi-asset, like it or not. Most of us were all FX and CFD war horses, but when you say how's it impacted, for a sales guy like me, it doesn't impact me, but my trading desk, it does, because they're used to liquid markets 24/5. Now suddenly with cryptos, we've got weekend trading. You won't catch me on the phone on the weekend, but our traders have to be there and man desks. Wow. You have, with equities, you've got open, daily closes. You've got gapping the next day, and it brings a whole new realm of risk management where, looking back at FX, whilst you have events, it's real time and you can do something about it. Whereas, say, with equity, if there's news after, I don't know, Apple drops 20%, there's not a great deal you can do about that until the following morning. So that represents risk. So I think liquidity providers, it's all about evolution, and I think now you do have to be multi-asset.
They're going to try. Okay, so but
can I just disagree with that?
Yeah.
I think there is a huge amount of bullshit talked about this multi-asset story.
Well, the retailer is demanding it. The retail guy is demanding it.
Well, I also disagree with that. One salient data point. Our risk analytics team looks at the entire trading book for about 30 brokers globally. I should know the exact number, but it's give or take 30. And in the biggest month that they've ever overseen, which was April of this year, they had visibility of over $5 trillion worth of volume traded in that month. Take a guess. Give me a number. How much of that was equities?
Not as much. No, clearly.
Take a guess. Give me a number.
5%.
So out of 5 trillion, $8 million. Okay. So the reality is, there's a lot of noise made about trading equities. MT4 is not an equities trading platform. I hope no one from MetaQuotes is sitting in this room, but nor is MT5. This entire conference is based off an industry where all of the revenue is earned in FX and secondarily in indices. Cryptos, I have to admit that I've got to slightly eat humble pie on this, because about 5 years ago I was sitting on a panel in London and I said, well, it's nice to see all the binary options guys are now in cryptos, slightly disparagingly, and now the cryptos guys are the guys that are actually making all the money. So I'm the one that looks like a bit of an arse.
But I think you're looking at the FX industry saying, look, it's a lot of FX, but there's a whole industry developed outside of this. I think the organizers have another brand doing probably other stuff out there. There's crypto guys.
Yeah, but equities guys don't trade on MT4.
No, what I mean is that the end retail guys, they would love to have one platform that can do everything for them, right? If they want to buy their Facebook share.
It's a total fantasy.
Do you think they want to go?
The guy who's sitting there, who's running his EA and MT4, that's punting away on whatever the most liquid product is, whatever the tightest spreads are, which is generally either gold or Eurodollar. Possibly, he might think, oh, Facebook, I just read that in the news. I'm going to click I'm going to click and do one trade of like $500,000, and then I'm going to go back to trading hundreds of millions a day in gold. And so do
you guys see that, Marcus, that your end clients kind of are moving on to other brokers who are claiming to be able to do everything
the equity
for them?
side, I mean, multi-asset means a whole range of things, and I think the equity side is a real small part of that, so we can talk about them in different ways. But yeah, look, equities are always an interesting one. As John's saying, it's kind of tough because there are a lot of other platforms out there with thousands of equity CFDs, and you get that one client that comes in. We have a few hundred. We offer a range of markets, and no matter how many you offer, they say, well, you don't have X share, that they saw in the news or something like that. And so then, okay, we'll roll out X share. He'll place one trade on it, and then we have to do corporate actions, pay for the data, a whole range of things as a retail broker for something that is a very small amount of revenue. So I completely agree on that side. However, then it's that situation on the retail side, and the client will say, "Well, if you don't have it, I'm going elsewhere." But I think that's a very small proportion of traders in general. So it's something that's nice to offer. If there's an easy solution for it, we'll do it. We'll always help our clients, especially premium clients, if they want something specific. We believe in being flexible, but at the end of the day, there's not a huge amount of revenue in it. Looking at, I think, multi-asset on a more broad level, not just on single stock CFDs, but I think there is, in the wider fintech community, this big push to be a crypto exchange, derivatives broker, stock broker, like pure stock broker, all in one. And it's kind of an interesting one because I think you don't see that same client conversion between them. You hear sort of horror stories of the classic, CFD broker buying out a stock broker to try and convert people back over to CFDs because that's where the money is for them. And, they go in with very high hopes. And at the end of the day, even if you're a diehard stock trader, to get them to trade stock CFDs in MT4, the conversion rate of like a stockbroker over to it's like less than 1%. So which I've always found unfortunate because, the stock CFD, it's, perfect for day trading, but no matter how much you try and push it, a very small minority of stock traders actually really want it. It's more of a, trading cultural change that needs to take place to facilitate it, which a lot of people have been pushing for years, and I see new cases for it all the time, but yet to see it delivered.
You'd expect your liquidity providers to be specialized. These guys to be good at their FX, and then you'll find if you need other stuff, you'll go get those for your clients and clients. You don't expect these guys to become some kind of multi-asset class.
It kind of depends. I think it always helps when the single stocks are, the LP has it as just a general easy to use offer. Something you can just plug and play with. We don't have to worry about, dividends, this whole range of things. The data reporting's easy because, usually they do that as a sweetener to get you back into, their core product. But the core product has to be good. That ease and convenience of, integrating all of those stock CFDs, just for a handful of clients isn't worth it if, the provider you're getting, the LP has, terrible spreads, terrible fills and everything like that. So again, that is front and center at the end of the day. You could have all the assets you want, but if your core offering where, that's where all the traders are going to go, that's where all your money is terrible, then what's it worth? So it's like a nice to have, I think, at the end of the day, but the core offering should be,
Francois,
supreme.
I think you've been quite specialized over the last
Yeah, me, I'm a
20
pony, I'm like an FX guy and I did metals, but I was involved in multiple retail firms. Obviously I was at FXCM or at LCG and etc. My understanding as John said, is on the MT4 world, this equity stuff doesn't really exist. The guys don't really do it. Now if you look at a firm like IG, CMC, Saxo, those guys have some equities offering and it seems like they're making money on the financing of those positions, right? It's not really the trade itself, but you basically charge the customer for the leverage, if I understand. So this is very profitable for them, I hear. But I don't know anything about this. I'm not interested in that business. I've been a geek over the routing for years. This is what I do. So if you need to route an FX trade, I can talk about it for hours. But if you talk to me about equities, I'll just decline.
But you want to touch crypto a little bit though, yeah?
So me, I have a very simple position. Is I am not a credit guy. I don't like to assess credit worthiness. I went through AIG going bust. I went through Lehman Brothers going bust. I was at Refco for a while. So I'm a bit paranoid about all this. And so I'm very comfortable in my position of arranging trades and then letting somebody clear the trade, right? So when it comes down to credit, crypto is like hell to me. It's just like weird exchanges that are unregulated with some dude that you send money there and then he has to do some wallet and then you have some guy with a USB key. I don't want to hear any of this, right? So I was very far from that market, but I found a clearer that's crazy enough to clear this. So I said, okay, but me, if I just arrange the trade and you deal with the credit mess, I'll do it. So I will launch a crypto ECN in the next couple of months.
You're entering the hell.
Credit is, right? But as long as I arrange the deal and don't take, I don't want to put my cash with whatever Binance or whatever, we have a balance sheet full of smoke and mirrors, I don't know,
Okay, I want to move on to the next.
From Binance's lawyers tomorrow.
Exactly. This is the one I know, that's why I say that.
So I just wanted to just ask you guys, one of you perhaps to define this story of prime. A lot of people use the word prime, prime of prime, prime brokerage, I don't know, something with prime. And all of you, most of you, some of you have the word prime in your names. You have prime products. We have a prime product. So definition of, can we have that, Jonathan? Nice definition of these words.
Well, at a slight tangent to that, I mean, I think the liquidity world is quite confusing for retail brokers, and I think we're the living, breathing embodiment of that because you've got four guys here on a liquidity panel, and our businesses are actually all quite materially different. So I think that's a good indication of actually how kind of confusing this whole world can be. I'm not sure I could define prime of prime for you, even though I call my business a prime of prime. But that's just because it's the easiest categorization. A prime broker, I think, a sort of institutional tier one prime broker, I think, is a pretty well defined sort of business model. So I probably don't need to.
Prime broker would be a bank, though, right?
I suppose yes. I mean, a credit intermediary. They don't necessarily need to be a bank. I mean,
but is there a non-bank prime broker? Well, not many.
Yeah, there's a couple. Like you can call guys
but mainly
like
banks.
Stone, like they've been in a prime brokerage business, and they're not really a bank, right? So you have people that
three biggest
ADM sort of. Do it.
But pretty much the FX prime brokers are banks.
Yeah, the definition is easy, right? It's like you have your cash in one place, and the person allows you to trade with the world, and you book the trade there, right? I think that's prime brokers. I think everybody agrees, right?
So your prime broker is NatWest Bank in London.
Yeah.
You guys have also a couple of prime broker banks.
UBS, SocGen, NatWest.
Yeah, these are banks.
Yes,
these are prime brokers.
Yeah, because it's better to put your money and have more lines, right? So if you trade with Stone, they're not going to have lines with Weirdo Bank in Germany, right? So
I think it's actually there's a business reason for it, because basically none of the banks like doing PB. I mean, I think the FX PB, I think that's pretty well known, because they go into that business, out of that business, etc. It's all about use of redundant credit lines. So banks have credit lines with all sorts of different counterparties, and if the credit line's not utilized, then they try and find ways to utilize that credit, because credit is becoming increasingly expensive for banks with their tier one capital ratios, etc. So if I'm a bank and I've got a massive credit line with UBS, well, why wouldn't I get $1 a million for just putting a piece of technology in the middle, doing the credit layer, and sitting as the credit intermediary? So that's why actually there was a tier two bank that recently announced they were exiting the FX PB space, and I think that was actually their fundamental mistake, because they didn't have that sort of that credit ecosystem, and so they were trying to make what is actually a fundamentally uncommercial business, commercial and stand on its own 2 feet, which didn't really necessarily work. But that's somewhat of a digression. The prime of prime space, there are different versions of prime of prime. There's true prime of prime, which I suppose guys like Saxo were previously doing. I don't know quite where they are with that now, but actually giving direct access to the banks, but not on a credit basis. You're still sitting as a credit intermediary, but letting your clients talk to the banks. There's prime of prime, which is the same, but on a purely non-disclosed liquidity reseller basis. And there's kind of what we do, which is we're predominantly a liquidity originator, predominantly providing our own liquidity, but then also augmented with third-party liquidity. So we're not offering a credit intermediation service, so we're not truly a prime. But prime of prime is the term that best describes us in the sort of understood industry parlance, if that makes sense.
Okay.
Yeah, I'm pretty much in line with John on that one. For me, prime of prime has always been a term that I thought was badly used, and I always said you're a liquidity provider if you give liquidity to someone into one unique system, right? Because you have a credit system, you have one system, you have one stream, so this is one liquidity. This is not a prime service, right? A prime service to me is somebody that says, okay, I have a clearing of a top-tier PB, you don't, so I allow you to use my top-tier PB, but I'll leave you to access whatever platform, whatever liquidity you want. For me, that was what a prime of prime was, but the term has taken over the years, a term which encompasses pretty much anybody that gives liquidity to some other broker, right? And so people say it's a prime service, I give you my liquidity as a broker, I guess.
Okay, which is what you guys, Chris, see it as, like you say, we're prime, we give you liquidity.
Yeah, we're one of those guys that are guilty of adding prime on the end of our name. But we're downstream. We work with great partners like John. They're up the food chains somewhat.
At least you added the O in, though. So, IX Prime sounded very uncomfortably.
Yes. For a while, you guys had a very similar name, IX Prime.
It's a long story for another time.
Yeah.
But yeah, no, we're just a market maker with a balance sheet. So yeah, we go downstream. But like to say, Johnny's business is fantastic. These guys a true prime of prime, or by definition. I'll let Jonathan have his own definition.
Yeah, from the retail perspective, it's, I think, more confusing than ever. I think my LinkedIn inbox is filled with numerous messages from people who are prime of prime of prime of primes. I don't know anymore. It's like lost all meaning. So from our angle, it's kind of tough. They're all just LPs to us and they do things in different ways. And I think it is becoming a bit more complex because you're seeing a lot more brokers now offering their institutional services as well. And, recycling, reusing pricing from other places, mixing it, doing it differently. So sometimes it's hard to know what you're really getting at the end of the day before you test it. And for some people that works, for some people it doesn't. But it's definitely more confusing than ever, so I don't think the name...
Yeah,
but I think the name doesn't really matter. It's, what's the solution that you're getting and does that work for you and does that work for your clients? And that's sort of how I see it.
We were thinking of rebranding and getting rid of the prime bit in our name because we felt as though, didn't really adequately describe what we do, but our new head of marketing taught me out of it. So you can blame him, he's at the back of the room.
Maybe change the name to something else. But so that brings us to I wanted to explain the liquidity mirage you mentioned, that word. Liquidity mirage, in my opinion, is, for example, if I'm a bank, let's say I'm UBS and I'm providing price to these guys, well, to two of them who have a PB, and us, ADSS, also has a PB. So if UBS is giving us a price, then we display it to our clients, and in the wider world, it might look like there's a lot of liquidity, but it's actually just UBS's price that three of us are displaying in our in our platforms, and when someone wants to interact with it, it might not be as big, as good of a spread than they think. That's a mirage in that sense, right? So,
well, I suppose if you're taking liquidity from three different providers and those providers are using the same underlying providers,
UBS,
I would disagree with you not disagree with you, but just in the way you characterize it when you said that we'd all have UBS, it's the same price from UBS. Like, the prices would be different, but the underlying liquidity would be the same, right? UBS might
give us better price.
Yeah, exactly. Might love your flow and your nice smile and give you better pricing than they give us, for example.
Yeah, we have a great price.
But I think the point is that, yes, you've got one single liquidity source which is providing liquidity to three different people. We then market that out to the market. If one client takes all three of those liquidity providers, then they're creating 3 times the liquidity out of one liquidity provider, and so 2/3 of the liquidity that they're looking at and the thing that they're trading on is actually not real.
Yeah, that's liquidity mirage, right?
No, 100%. I think the small caveat I'll put to that is that it really depends on the quality of the flow, because UBS is not going to care to get 3 times the same trade if it's good flow, but UBS is going to care to get 3 times the same trade if you get run over, right? So, typically we don't like to get the same trade at the same time, right? But we're not going to care if it's 3 times a good trade, right? So it all boils down to the quality of your flow for these type of issues, I guess, right? So
I just wanted to quickly go through something else before we will have some time for questions from the audience later on. But so I wanted to touch on the last couple of years, kind of like what's changed. If we go back, you were saying you were on a panel like 4 or 5 years ago talking about this stuff, and what happened 3-4 years ago? Was the spreads in majors better? I mean, worse? Does it always get better? Do you expect in 2-3 years the spreads to get better, the margins? Or will we have a time when you say, listen, I'm pretty sure in 5 years, euro dollar is not going to be as nice in terms of spread, in terms of margins? Or do you expect over the years things to always get better because of tech, because of technology, because of speed of... You know what I mean? So would you expect?
I think if Euro USD gets any better, it's going to be inverted soon. From my angle, look, it's been like a very much a race to the bottom with the majors the last few years, and it's kind of made things a bit, from the retail perspective, a bit vanilla when you look at like the top 10, 15 providers, in live quotes, and Euro USD is kind of matching. But so from my angle, I don't know how much better Euro USD can get. I'll leave that for everyone else up here. But from the client angle, I think it's been a lot more, yen crosses, pound crosses, and things like that because everyone's kind of getting a bit more vanilla on majors and that's now a point of differentiation. That's a thing that, people are going to switch for. If they're spread sensitive, serious traders, I think from my angle, that's what I see people now saying, well, everyone else has the same Euro USD, but yours is, and you see the variety of different prices and spreads coming through on those crosses vary a lot more. So maybe, the continual, tightening is going to happen on those, but, with current market conditions, maybe we'll finally see, the race to the bottom, as people call it, kind of end. But again, I guess a lot of that happens upstream, which is where these guys come in.
Well, I think gold as well is, you mentioned that there's sort of it's much harder to differentiate yourself in euro dollar. I think that's just a fact. I don't think anyone would disagree with that. I think gold's been one area now where obviously there's significant volume going through it. I suppose it was probably about 3 years ago that gold overtook euro dollar for everybody that was providing to retail as the most traded product. And gold feels like the main battleground for us and our peers at the minute. We're just sort of trying to kill each other to get 0.001 of a cent of gold better than the next guy. So, but I think in a general sense, I'm not sure that liquidity, the spreads can always continue.
We'll see like 1 cent in 3 years in gold in spread. Like it's going to go.
I'm not sure here, because what is clear is that the top of book pricing can hardly get any better, right? We're all in agreement at 1.2 euro dollar. When I started my career, like I remember seeing like AIB was quoting 1 pip euros. I'm like, wow, those guys are so aggressive, right? So yeah, it definitely went down over the years. But if you look at, let's say, people that try to do size, right? If you start to trade like 5 million, 10 million, 20 million, 50 million, I think the picture is completely different. And I think actually the liquidity situation is dire for many people. I was at a breakfast with NatWest a while back, and the quant there was saying the impact of a 5 euro these days is the same impact that it was 50 million 5 years ago. Okay, wow. So if you have stuff to do, you'll find that actually the price disappears very quickly, that you don't get your stuff done, and you get massive slippage on orders, right? And that has been my business for years. I've always been in that kind of fringe of the market. And the reason I'm going back to the retail market is because I don't find liquidity anymore. There's 10 big market makers when there was 20 or 30 a couple of years ago, right? So it's all JP Morgan, Deutsche, and UBS these days, and the other ones are trying to be there. And I think you have a great top of book, but the mirage is just behind it.
So
right?
We should stop talking about small size and the spreads. We should just talk about what's going to happen when you want to trade, $20 million of gold now and in 3 years. That's the more interesting. Or 3 years ago. 3 years ago, $20 million of gold. So you're saying euro essentially 3-4 years ago. It's not necessarily that the spreads, for example, are better now in 10 million, 20, 50 million euro dollar than a few years ago.
I think the spreads are all over the place. If you look at a spread for 50, some people are paying 3-4 points, some people are paying 1.5. I'm like, it really depends on the relationship you have, the experience people have on your flow, and people are obsessed with attrition curves now. It's just like every single bank doesn't want any recycling. We don't want any what do you call that? When we test you for leakage, whatever. People are obsessed with these attrition curves, right? And that's why on our side we're trying to turn the problem around, and we said, okay, we're going to go back to the retail community. And we're going to tell them, okay, if you have a good attrition curve and you see those amazing spreads, you should be working your orders. Because the institution on the other side, they're desperate for liquidity. Well, I've never seen people that are so big coming to us as a small, agency broker and have with problem of doing 20s, a problem of doing 50s, and trying to find liquidity to do all those amounts, because when they have to do a 50, they don't find a lot of liquidity to get it done, right? And
they can cause a lot of market impact as well.
Yeah, the market impact is insane. I'm like, I'm getting some customers which were easy customer, like Gunther in the mountain of Switzerland, getting drunk at lunch and doing halves and ones. This guy comes in, he does 5 million, and UBS called me and tell me I'm a murderer. And I'm like, guy, I cannot get you better flow than this. I mean, what do you want? It's just liquidity has disappeared, I think. Maybe I'm wrong, but this is my experience anyway.
What do you think, Chris? Do you see big tickets?
Francois just mentioned relationships and experience. And so looking around this room, there's a lot of familiar faces. And what is nice is that race to the bottom that you mentioned, everyone knows spreads, we're also given the same price. It comes down to fill rates and what have you. And what I like to say is I don't like talking to my clients, because if you've gone a week, 2 weeks without speaking to someone, it means there's no problems. And they're humans, and they're clients, your end clients as a retail broker. You get hassle from them, which you pass the hassle to people like us.
Pricing comes downstream, complaints go upstream.
Exactly, yeah. So the good thing is, I saw someone yesterday said, oh, you didn't tell me you're here and we haven't spoken in a month. Well, that's a good thing. There's no problems. So, the days of...
That's nice. You reinvented relationship management there. I don't want to talk to you for years.
It worked.
And then that's good.
But yeah, no, zero spreads, zero comms those days. I think people have matured a bit now. That, like I said, there's more to it than that top of book, great price. When if you want to do something a bit more customizable, yeah.
So do you guys finally think, in 5 years from now, big tickets, 10, 20, $50 million of gold, euro, dollar, is it going to get better or worse in spreads the way you execute it.
In 5 years' time, fiat currencies won't exist anymore, will they?
Oh, you're against cryptos, aren't you? So, which is what we're going to go to next. Fiat currencies will exist, and this panel
who knows?
will be there. What do you think? Better or worse?
What do you mean, like crypto going to be there or not? Is that a
No,
question?
crypto's going to be there. Fiat's going to be there. But what do you think of the spreads for bigger tickets? It's going to get better.
I don't know. What I say is, like, I think the regulators, like after the crisis in 2008, they said, okay, we're going to regulate this industry, so it's going to be clean. Right, and so now you have to put 5 times more cash to do the business. Now every prop trader is going to be fired, right? And what they took off a lot of people that were taking risk off the market. Why was Russia so important to our business? Because the Russians had a model from the 1920s where we had guys on the desk punting all day long. Like you go to a bank now, you'll be hard pressed to find a trader that has a fiver in the market just to test the market.
Because they're not allowed to.
They're not allowed anymore because of regulatory nonsense, but the limits are much smaller, so they don't take risk anymore. So if you don't take risk, if you cannot take the information of the good traders and use it for your own book, then you have to rely on very simple strategies where, in essence, the banks are running B-books now. They just don't want to see anybody as directional. They just want somebody that trades, and when he buys, he goes down, and when he sells, he goes up. Okay? So if that's the only business you have, you're drying out the liquidity for people that actually have stuff to do and that know a bit about the business, right? And so I think I don't know where it's going to go, but I will hope that there will be less regulation and that they go back to put people that take risk in the market.
Maybe in 5 years' time, all the big retail brokers will be offering liquidity to the big institutions.
Or we just buy all the big banks.
Why not?
Like
John, I really like you saying that. This is actually my new product. This is exactly what I'm trying to say here. Thank you.
So, just to clarify, just quickly before time's up, do you guys trade cryptos? You guys do CFDs? You guys don't do anything to do with cryptos, right?
No, we do. Reluctantly,
a bit of CFDs.
Yeah. Although I said I'm going to launch a crypto ECN. That's crazy enough to put the money with those people.
You're getting involved, yeah? You guys do positive cryptos or?
So we offer a large range of cryptocurrencies, definitely seeing a positive side of that, seeing more growth than we thought we would. It takes up a bigger part of the book now, which is, great part of that diversification play, which I think we're all happy to see rather than, freaking out when, the book is too much, concentrated on gold. So, look, we're very, very positive on it. We keep expanding the offering. I think the thing too, the best and worst thing about crypto is it's very dynamic. It's constantly changing. So your liquidity offering has to keep up with that on instruments, on depth, on spreads. And, whereas, things in other industries might change over 6 or 12 months. It's like, every few weeks, it's like, oh, okay, well, this has to be reformulated. That has to be changed. Things just change very quickly. Maybe that'll die down in the next few years as things, we see a lot more liquidity enter the market. A bit of a slowdown in that sense, but it seems to be no stopping it at this rate.
Great, excellent. I'm going to go to the audience to see if there's any questions, and otherwise we're done. There's one question over there, 2, 3, George.
Hi, what do you think about the practice of profit sharing?
Ooh, that's not for these two. Well.
You don't want me to tell you what I think about this.
Chris, do you want to take this one?
I like it if it's a good profit share and it works.
Profit sharing as a liquidity provider to retail brokers, I think, right?
I think there's a lot of it being thrown around.
On that.
I haven't come across. I come across quite a lot of fairly crazy offers that some of our peers are giving, usually to our clients. And sometimes you just have to hold your hand up and say, look, if someone's going to take more risk than us and potentially recklessly so, then fine. And see you in 3 months' time, Mr. Client. I mean, I think we haven't found that there are many risk sharing or revenue sharing deals that tend to be sustainable, because I think if they work really, really well, then the retail broker quite reasonably looks at the risk and says, well, why don't I just take it myself? Why am I paying any of it away? And if it doesn't work very well, then the person that's offering the profit share understandably runs away from it pretty quickly. So there don't seem to be many examples where there's a kind of a middle ground that leads to a risk share deal being particularly sustainable.
They don't last long, sustainable, yeah.
They can do, but not. But
not
they're the
many
exceptions rather than the
years.
rule, I think.
Yeah.
I've had a lot of firms that have been doing this for a long time, now still around. I remember Fortress blowing up in like spectacular fashion, doing profit share all over the place. I remember Gain trying to do this and getting like slapped like all different ways. So I think it might be room to have a good one, but you have a massive credit risk to the person in front. I'm like, if your client is making a lot of money, withdraws the money, then who pays? That's my...
Yeah, it's not, when it sounds too good to be kind of a good deal, too good to be true, then it's probably not a good deal.
Yeah, we all know the horror stories of what's happened over the last few years with certain brokers, but I think it's, as a risk-taking market maker, it's having that confidence to say no to a lot of deals, because naturally as salespeople, you want to say yes, but you hear sort of X percentages being bandied around, and you know how that ends. You might have a short-term win, but it ends in a certain way. So yeah, there's room for it in the market, but it's got to be the right deals, not every deal.
Marcus, you guys involved in that?
Not really, kind of
offer you?
like what everyone else here is saying. It's kind of tough because it just becomes a real conflict. I think a lot of retail brokers, I know that they've become more popular, and I don't know if that's a good or bad thing overall. I mean, you do hear some insane deals being made, but it's a bit of a conflict because I think retail brokers see it as a bit of a win-win. It's like, oh, offload risk a bit, but still be able to make money if it goes good. But then how does that work over the long term? Like, how is that sustainable? That's the very point being brought up here. It's one of those things where they won't last long because if the broker's able to build up a bit of revenue and then be able to sustain their own book, they're just going to take it all back anyway. So it's kind of always a temporary solution for better and for worse. So I guess we'll see how it goes over the long term.
Yeah. I think we had a question right here as well, and then over here.
Thank you. I'm coming from retail, FX retail side, and first of all, congrats to the liquidity providers for bringing down the spreads, on FX. They're amazing, so we're very happy. However, we're not happy about swap fees. I think they're horrendous, on retail side, and I don't know. First of all, why they're so bad for retail traders? Because I've seen, long and short sides both negative. Like what? Like why? And so So my question is, will the swap fees follow the same path as spreads and will be brought down for the retail clients? Thank you.
So I think the long and the short side both being negative is actually a function of the slightly bonkers interest rate environment we have at the minute. So if you think about it, the way that a swap actually works is it's calculated by the banks as an interest differential, obviously between the two different currencies in a pair. But the banks, obviously, because they're performing the service, provide a little spread around that. So they're taking a little bit of offset on it. And if you're in a situation where the rate differential between the two currencies is essentially zero because the interest rate in both currencies is zero, then the offset that the bank is charging in the spread effectively means that both the long and the short of the swap ends up being negative. Essentially, this is another conversation about the carry trade, right? I mean, there isn't a lot of positive carry in the market at the minute, so the swap charges kind of look egregious, and I can kind of see why retail clients think that. I mean, that's what I would say. I think it's a function of the underlying kind of interest rate environment, really.
Yeah, no, maybe I don't have much to say this because we're only intermediate on the trade, so we don't hold people cash, the clearer does the swaps. But what I would say is that, in the old days, you could make money on the cash from the customer you had at the bank, right? Because you was getting an interest, and you had like differences that were big in interest rates. So as John said, you could like really reflect that. And now maybe people put more fees in them because the cost of lines is much bigger. To be able to have the NOP to open up the positions, and if you don't trade enough, you got to make the money somewhere. Because you have a lot of people that come to you and say, okay, I need a big line to offset my risk. We dump you 100 euros on the books, and we don't trade. So do you know how much it costs, a prime like John to go to the banks and say to put cash there and like to hold this big position for you when you put one position and you don't turn the line, right? So I'm not saying you charge a lot on swaps. I'm just saying some, might, but I'm saying you got to pay for the service, right? Like that's what.
Just to explain, so the swap, essentially two elements, right, that are important. One is the central bank's interest rates, and one is how much our prime broker banks mark up. And then you have also the middlemen marking up who are providing to you. So you have that element, and that's it. There is nothing else other than that, really. I think
just on the swaps, one thing that we do that not everybody necessarily does do is so quite often if you've got a tier 1 PB, you just do all your rolls with the PB and or the LP side of the PB, and that's where you get your swap rates from. We, in the same way that we receive aggregated pricing on spot, we take an aggregation of all of our LPs and take the best rate on the swaps. So there are different ways to do it. It's not always a big focus, actually, frankly, for the primes to really compress swap charges. But there are ways to do swaps badly, and there are ways to do swaps well.
What you said, there's no extra charges on that side. But what I've seen is different retail brokers will have very, very different costs. So why? They must be adding something on top of it.
That's what they're marking up, essentially.
They're marking their own top.
Yeah.
There is also the problem that in MT4, you have to set the swap rates in advance of when the swap market actually happens. So the retail broker effectively rolls the client's position at 10 p.m., whereas they're going to have their hedge positions rolled the next day at whatever time their provider rolls in the market. So a retail broker is actually taking a little bit of risk on the time differential between when they're swapping the clients and when they're actually receiving the swap from their LP. So a lot of retail brokers handle that by basically adding a markup in order to cover that risk differential, and I guess also make yield. But so there are a few quirks to the swap market that do make it quite difficult to manage. So, unfortunately, it's to some extent the cost of doing business.
LP counterparty risk. Where are the biggest pockets of concern, if there are any? And second question is, what can retail brokers do, well, to not get, not to have that risk insofar as their LPs? Thank you.
I think I'll go with that one quickly. This part of doing business, you got to check your counterparty. What I'll say is ask for the financials. Ask them for the last 3 year financials and see how much cash they got. That's
balance sheet. You mean?
The financial. See, so for the regular broker, they gotta have an audit somewhere. Ask and check how much cash they have.
Is there counterparty risk insurance in Europe? I don't know. I'm just.
You do have some guys that are small brokers that have some insurance. Lloyd's there's a kind of some insurance you can say up to this amount. Did you have in the UK? You have the FSCS that covers you for $100,000 or something. And then if you want more than that, some brokers go to Lloyd's and they assure the balance higher. I think a couple of brokers do that, and I think you can do it yourself. But I'm not 100% on this. Again, I'm not in the credit world. I'm intermediary.
There's a little bit in this question, not specifically relating to you, sir, but what we find with a lot of retail brokers is that a lot of retail brokers come to us and say, look, we're nervous about counterparty risk, and we're like, yes, you should be nervous about counterparty risk. And then in the next sentence, the retail broker says, but I want you to give me 500 to 1. And it's like, so I think one of the 500 to 1 leverage. One of the I think critical things for a retail broker to actually think about when they're engaging with a wholesale liquidity provider is, does this offer, is what these guys are offering me or people are offering me, does it actually make sense? Are they offering me 1,000 to 1? Are they asking me any questions before they open my account? Is this a business that is managing their risk in a sustainable way? Because I think balance sheet, yes, obviously is important, but Lehman's had a pretty big balance sheet. It's actually leverage. It's leverage that kills businesses.
Yeah, you're right.
So there's no silver bullet answer to the question. It's just something you have to do your due diligence on and look at all the different aspects. And really, what it comes down to is, how well managed is the business that you're dealing with? Because actually,
your own business is one thing, but my concern would be the counterparty.
Well, exactly.
So the counterparty defaults on.
So the counterparties that your wholesale provider would hedge with.
Yeah, the LP that I'm dealing with.
The LP that you're so
I'm a retail broker, so I'm dealing with you guys, which are LPs. Okay, what risk do I have? I mean, how do I measure that? How do I avoid that? Can I insure myself?
You got to look at the background of the companies and all that.
Yeah, that's about it, right? So if it happens, it happens. If you're unlucky, you're unlucky. Okay, that's what I'm saying. Do you consider that it is a significant risk on the European continent or not?
Yes. I think it's actually probably something that retail brokers don't actually think about enough, to be honest.
Yeah, nobody thinks about it. That's
until a company blows up. I mean, look, everybody has their story, right? These guys have got the biggest balance sheet on the planet at ADS. We're our parent company is a $9 billion hedge fund. You know, there's. But really what it comes down to is we operate in a world with high leverage, we operate in a world with microsecond latency, so no matter how big you are, if you haven't got your risk management right, I'm talking about at the wholesale liquidity level, if you haven't got your risk management right, if you haven't got your processes right, if you're not a sort of well-organized, well-oiled machine, then you're going to struggle. So I think that the advice that I would give to a retail broker is when you're speaking to a wholesale liquidity provider, be thinking in the back of your mind, is this too easy? Are these guys just giving me everything without even really thinking about it? Or is there some kind of risk rationale behind behind the answers that I'm getting to the questions I'm asking?
Exactly, and also just plan for people to go bust. You know, you need to have redundancy into everything because you do the best analysis about the counterparty risk and they might still go bust, right? So you need to like plan for that.
One last question, maybe this is funny or not, but I've been told. Let's say that I'm a broker and I have, I don't know, 5,000 customers and they're 90% winners consistently, month after month, as opposed to 90% losers. Are you guys as LPs going to cut me off as a result of that? If I find winner brokers? We
would absolutely love it. I genuinely could not tell you which of our clients make money or lose money trading. It's just not a metric we look at because we're operating a spread capture model. We're trying to capture the client's transaction costs. We're not running a B-book.
Okay, so you won't. Okay, so you don't really care if my clients are winning money against you. Okay.
There are different models there, right?
It does depend how.
The question is a little different. It's like in the retail world where you have the margin positions, you see the buy and the sell. What you care about is having flow that's easy, aka the guy tend to lose money. Okay. The LPs, the institutional LPs, they don't have the luxury to see the buy and the sell of your trades. Okay, so you can buy to UBS and sell to Goldman. So how do they know it's good flow or bad flow? What they care about is the market impact of your trades. Meaning they want to do an attrition curve, as I was saying before. They want to see what happened after you trade 1 second, 5 seconds, 10 seconds, 5 minutes later. Because market is 10, 11, you buy at 11. What they're going to try to do, now they're short at 11, they're going to try to buy back at 10.1. Okay, showing to the institutional market, hey, is there a sell at 10.1? I give you a good price, everybody sees 10, I show you 10.1. That person sell at that time, they made short 11, buy back 10.1, they made $90. Okay, so for them, they don't care if you're making or losing money long term. What they care about is like you traded and they have time to find the other leg of the trade somewhere. And so they need 30 seconds, a minute, 5 minutes where the market doesn't go against them. So do they take any flow? No. Do they care about the customer making money or not? No, they don't care about that. What they care about is like if you trade and in the first microsecond after you trade, it goes in their face immediately, yeah, they'll turn you off, okay? But they don't care about if you make or lose money. They care about the market stability after you traded in the next 30 seconds, 1 minute.
We're out of time, guys. Done. Thanks a lot. Thank you.
Thanks, guys.
Thank you.